Welcome to the Tier 1 Sworn Officers presentation for State Employees Retirement System. My name is Jennifer Edmiston, and I am happy to go through the information that will assist you in preparing for your pension. Let's get started. Some general contact information is listed. Our number is listed, our call center number. That is our main number for state retirement. So if you have any questions regarding pension, disability, survivor benefits, we are here to assist you. We have a call center set up for that. If it gets into more detail, or let's say you want to schedule an appointment with a counselor, we're happy to do that. You would do so by either calling the call center or sending an email into CSRS, which is listed there for you as well. And then our web address is listed too, that has all of the pension information listed that you're going to need in preparation. Some general terminology for CSRS, just so you know when you're looking on the website. What this equals: annuity is simply another term for pension payment. I've seen emails coming through that will ask what that is. It's simply just another word for that. Tier 1. Tier 1 is an individual who became a member of CSRS or reciprocal system before 1/1 of 2011. That means you paid in at least 1 month of service credit to CSRS or reciprocal system prior to that date. Vesting means how long do I have to work to be eligible for a pension. Vesting for eligibility would be 8 years for Tier 1. Now let's look at our website and member services to show you what will be accessible and visible for you to review in planning. So our website, when you put in our website, comes up, it looks like this. You'll see at the very top, it's State Employees Retirement, Judges, and General Assembly are all housed here. You will go to the State Employees Retirement link in the top left to get all information regarding to State Employees Retirement System. You'll see that there's multiple drop downs across the top. The picture of the individuals underneath that, all of those links there, if you click on it, provides more information along with the helpful links below. But specifically for retirement, let's go ahead and show what that looks like. And you'll see retirement benefits are listed. We have it separated out between Tier 1 and Tier 2, and alternative and regular formula, along with frequently asked questions, information on credited service, optional service questions, payments, and refunds. Calculators is another link that can be very helpful and assist you in reviewing and planning information. You'll see there's a Social Security benefit estimate calculator for those that would apply to, a service credit calculator, sick leave and vacation chart will be listed, which we'll get into more detail how that will assist you upon retirement. And then the calculator training video is posted to obtain a pension estimate and how to do that on your own online account when you're logged in. So in order to log into your account, or if you've not done so, let's walk through that. You can either go to Member Services Login Instructions or sign in using Illinois Login. You will need an activation code to set up your online account. Even if you had one previously set up, you'll need an activation code to sign up the new way to log in. You can access one by either requesting one through email to us. We can send one to your state of Illinois email address, or it can be mailed to your home. So you will see that if you don't have an account set up, this is important to see because when this was first implemented, we saw some hiccups here. Everyone was trying to enter their email. If you don't have an account set up, the new way to log in, you would go to sign up on the bottom of that screen. If you do already have your account set up, you're going to enter your email in. It's a personal email and you'll sign in as usual. So when you're signing in, this is what the first screen will look like. You'll enter the general email, first and last name, you'll set your password and then click sign up. And then after that is where you will be prompted to enter your activation code to allow you to finalize setting up your account. When you log in, this will be what your account looks like. This is simply an example, obviously with Jane Doe, but all the information will be available for you that applies. The first basic tab has some good general information. It tells you your age, your tier status, membership date when you started working for the state. It tells you your current plan. So for Tier 1 alternative sworn positions, it will say alternative, non-coordinated, Tier 1, 12.5%. That means it's an alternative position. Non-coordinated means you're not paying into Social Security as it is a sworn position. It's a Tier 1. This person's a Tier 1 and they're paying 12.5% into their pension, which is the highest that you would pay in. But obviously then upon retirement, you will get a higher percentage for pension, which we'll get to in a little bit. This person is with state police. They're paid their salary is listed as monthly. It shows their current salary rate, and it will show the last salary date, that second from the bottom on the right hand side. I always like to point that out, especially if you're going to be going out under final rate of pay and you're wanting to see a calculation, or you're wanting to see what's been posted, what payroll, and then look at your benefit or an estimate. When you look here, it tells you what we have posted through from your agency. Keep in mind, when you receive an increase in pay or salary, if you have an increase coming this year, it takes, once you receive it on your pay stub, it'll show up to us usually about 3 or so weeks later, because it does take a while for it to pay out to you, and then payroll to come through CSRS to get updated with us. So you know whatever we have on file, so you have the most accurate information. The account tab has some good information. It tells you your total service credit in years and months, total contributions, final average compensation, and your earnings calendar. Anything on your online account, if it is underlined, will give you additional information. So let's look at the first one, which will reflect your total contributions. This person in this example has paid in almost $27,000 total into their pension. For anyone who is preparing to retire, since it's all percentage based, it's the same for all of us in the sense that whatever we pay into our pension while working will be exhausted into retirement within 2 to 3 years. However, it is a lifetime annuity, so it will continue for the rest of your life. What I would like to highlight here is the second line. It's labeled widow and survivor. Of the 12.5% that you pay into your pension while working, 1% the state automatically separates and places into a widow survivor fund. That is done. So at the time of retirement, if a member passes away after they're retired, their survivor would receive 50%, which we'll get into later, 50% of the pension. That little bit of money is set aside for that. What I always like to highlight, whether in person as well in a classroom and here, is to know that that money is separated. Therefore, when a person retires, when you retire, if you do not have a survivor would be considered a spouse, minor child under 22, still full-time student. Then when you get ready to retire, you can take that money back. Whatever that separated amount is, the widow survivor money, you can take that money back to yourself. You would have two choices on what to do with the money. You can take the payout to yourself. If you do that, we would withhold 20% for federal taxes, or it can be placed into a qualified retirement account of your choosing. Now, let's say you take a refund because you do not have any survivors at the time of retirement, and down the road you do get married. After being married a year, you can request to buy that survivor money back with interest to guarantee your spouse half your pension should you pass first. So this is the only time we really focus on this and talk about it. You'll see there's a question on the pension application when you are ready to retire. That's what they're referencing. But I'd like you to know, why is it separated out and what is it there for, what is it for? And then when you do retire, if you do not have a survivor, you can actually take that money back. Final average compensation summary. This is an example for this person. They use the last 48 months working. So the system will automatically pull through their earnings for that period of time, divide it by 48, and that's the final average compensation. Yours will reflect on yours as well, but it shows you exactly what we're using, whether it's a final average compensation or a final rate. We will get into the description as far as how that is calculated later. Earnings and service credit by calendar year. This will show and provide to you all of your earnings and service credit while working for CSRS. Sworn officers do not have a qualifying period, so if you started as a sworn officer, you will not see any gaps in service credit even when it was at the beginning, because you paid in immediately. Service credit adjustment, and there is a guide at the bottom when you look at your own, but that's going to show you any any adjustments or purchases that you've made. Let's say you were off for 6 months to take care of a family member and you bought that back, that will reflect. Or military time. That way you can go to see exactly when and where it was added back in. We're always happy to assist and look that up for you, but this is a good resource for you to be able to review it on your own, to see exactly when it hits your account and to know that it's included in your calculations for your benefit. The benefit tab, I always like to refer to as more of our golden ticket or golden tab. It tells you what is your eligibility date and what is the estimate. Also new on here is that print statement on demand. You could at any time print an online statement. It's not like you have to wait for a once a year like it used to be in the old days. I remember those days that we would have to wait for it once a year. You can print one at any time. So this person is eligible under Alternative Retirement Program pension formula at any time. And this shows the current estimate. It is underlined. So it's going to show you also when we get there how it is calculated. Here's an on-demand statement sample. It will fill in with your information. This is just simply an example, so we don't have that in there, but this will show you all the information pertaining to you on the date that you print it. This is an example showing you how the calculation is completed. In this example, and obviously yours will be pertained to you, this person will have over 20 years of service credit in the alternative formula position. They receive 3% per year of service credit. Now this will not include sick and vacation time. That will be added on later, and we'll discuss that later. But just for this example, this is at 60.9999%. They do go out 4 decimal points. It is multiplied times the final average compensation. That gives the estimate of $8,296.48 a month and gives a projected retirement date as well. This is simply under the benefit tab that you can access at any time to track your pension as you're getting closer. This is a continuation under the benefit tab. It shows to you if you were to become unable to work due to a disability, whether it's non-occupational, non-work related, or occupational. It tells you the estimated dollar amount you would be eligible to draw. The second half shows you what the estimated death or survivor benefits is if you were to pass away while working. Your numbers will be different. Again, this is simply an example. This shows the non-occupational death survivor monthly benefit amount there. There's a maximum family benefit. There's an occupational death survivor monthly benefit listed if you were to pass away from a work-related duty. The bottom two numbers, I like to just kind of specify what they're referring to. Years ago, I didn't really get it. So lump sum death benefit without eligible survivors. There's a lump sum benefit, and you see that it's higher than the number underneath it. That shows what CSRS would pay out to your beneficiary if you do not have a survivor, if you were to pass away while working. The bottom line, the next one, says lump sum death benefit with eligible survivors. That means you have a survivor, meaning you're married, you have children that qualify. There's still a payout, but it's a lesser amount because your survivor will be eligible for a monthly benefit that you had earned for your pension. The COLA buyout is still available at this time. This shows how you will run the estimate as it applies to you. So you would answer the question, are you married? I've had many people ask me over the years, why do they ask that? If you are married, typically it will make the buyout a little bit higher because the system is calculating in the fact that you have a survivor. Therefore, the amount that CSRS would have to pay out in a lifetime benefit is higher. This person is not married, so we marked no, and we're going to look at the estimated COLA buyout. So for this person, this shows exactly what that buyout amount is. It shows to be $233,363.01. What I like to point out to all members I meet with is the math at the top first, and then we'll look at the chart. So the formula that was set up when this was put into place in December of 2018 shows that What's calculated first is your present value of your pension, showing a 3% compounded increase throughout the years. So the actuaries are working behind the scenes and they're figuring out how long we're going to live. I don't have access to that. Don't really want to know. But it shows in this particular instance, they're saying the 3% compounded for this person will cost the state $1.6 million. Then it's figured out what the value is at 1.5% non-compounded. That's 1.3. The calculation to provide to you the COLA buyout is they take 70% of the difference of those two numbers. That's the simple math behind it. Just so you know where it's coming from, where they get those numbers to start. Now, if anyone's considering the COLA buyout, I highly encourage you also to look at the long term. This chart will show to you for the next 20 years what your pension amount will look like depending upon what you choose at the time of retirement. On the left-hand side, it's blue, color-coded here, 3% compounded shows. This person's increase would kick in 3% compounded in January of 2029. More than likely they're 50 retiring, so therefore they would get their first 3% compounded at 55. Versus the right-hand side, that's labeled 1.5% non-compounded COLA. That shows that if the person takes the COLA buyout, first of all, the money has to go into a qualified retirement account that the member chooses. Examples would be deferred compensation or an IRA. The trade-off is rather than getting that 3% compounded after being retired at least 1 year and at least 55, there will be no increase until the January after the member turns 67. So this is a great side-by-side look for you to see and track over the years what your monthly pension looks like depending upon what you choose at the time of retirement. There is also a total buyout option. This allows you to run that. So again, they ask if you're married or not because that also goes in with the calculation. The math of this is at the top. Essentially what's done is the state figures how much would the pension cost the state for a payout over a lifetime. They come up with their number. In this case, it was 1.9 million. They offer you a very one-time buyout, 60% of that number, which in this case is a 1.165 buyout. If this is something you're interested in, there is a link that allows you to say you're interested and send the information in to us that's requested along with a birth certificate. What I like about this, and I've sat down many times with members and look at it and say, well, you can look at it and say, well, let's take the total buyout, compare it to what the monthly amount would be to look to see how long would that last you into retirement dollar for dollar. Obviously not taking into account any interest earned on that, but it gives you kind of a good starting point to look to see if that's something that you would be interested in. On the left-hand side, Calculators has two great resources here. One is the federal tax withholding calculator. That applies simply for retirement income, so don't use it while you're working, but it's a good way for you when you are retiring to go ahead and enter the information from your W-4P form, enter it in, and we'll tell you how much will come out based on current federal tax tables. There's also a pension estimate, and there's a tutorial right next to it. This is a wonderful way to see exactly where you would be, which including your sick and vacation time. So first, when you go here to run your own estimate, you would have to say, I know it's just an estimate, I'm ready to start it. Then you would enter in your sick and vacation time, what you would have, what you're anticipating to have at the time of retirement. There's a level income section. This does not apply to sworn officers. It will then show you when you're eligible to retire using sick and vacation time. Meaning, let's say you are 50 and 24, but you have a year of service credit, you will see the date adjust. Or on the flip side of that, let's say you want to work longer than what the date is showing you. You can go in there manually adjust it. The separation date is always the last of the month you're done working. You always retire the first of the month after you're done working. Therefore, in this example, they listed January 31st of 26. Effective date would be February 1st of 2026 and go next. Now, this shows the calculated benefit amount. It shows you what final average is being used, and it shows you without purchase. So they did not list any vacation time here. If you list vacation, it will include it. What I'd like to point out here is that calculated benefit amount is underlined. So when you're looking at it on your own online account, click on it. It will show you exactly the calculation that you're coming to. What's nice is it will also show you what the percentage is. So let's say you're waiting on a raise. If you know what your percentage would be at that particular date, you can adjust that accordingly to figure that out yourself as well. You can also download an actual retirement estimate letter that is available for you to review, save, or print. Nominated beneficiaries, is extremely important that you keep this up to date and current. This shows you what you have on file or who you have on file and when it was updated. If you want to make a change of beneficiary form, that is located under your forms and applications, 2 tabs down on the left. You would fill out a nomination form to adjust it. This is what it will look like, except the top part will be pre-filled with your information. You'll fill in the beneficiary, for example, for primary, beneficiary name, last name, first name, middle initial, list the relationship and phone number. We see tons of these coming through. They're not listing relationships. If you're not related, you can put friend or not related. But if it's a spouse or children, please specify that. List the street address, their person's date of birth, and the last 4 of their social is optional, but it would help us if something were to happen to make sure we can locate the right people or persons. You can list a primary, secondary. If you need it to go further and you don't have enough room, you can attach additional paperwork to be submitted with that, additional pages if needed. So when you name your beneficiary, you want to make sure it's current. If you have adult children and their names or addresses have changed, send in a new one with the information. You would treat each beneficiary form as if it is brand new, so you won't just change one person. You treat it all like it's brand new. How you identify meeting relationship. Minors. Your state is your beneficiary if you don't list anything, so please make sure it's up to date. Keep in mind, changing your beneficiary form with CSRS does not change life insurance and does not change deferred comp if you have that. So you could have 3 forms, 3 locations to make sure the beneficiaries are up to date. Please make sure you do. If something happens to you, you have your life insurance, for example, as an ex-spouse and you never changed it, even if, let's say, it had current spouse with us, that life insurance would get paid out to whoever is listed as beneficiary. So please ensure you keep those up to date. Demographics simply shows you what we have on file, your address, phone numbers, and email. You can go in and change your phone numbers and email at any time. While working, you do any change of address forms with your agency through their payroll. Once the payroll comes through and updates at CSRS, your address will be updated with us. So that's what this is indicating. It tells you the form that they will need from you, and you could reach out to your payroll if you need to change your address. Forms and applications show you what is available at any point. The beneficiary nomination form is first. There's a demographic confirmation form, a rollover certification, and then the packets are listed, meaning any packets for disability. The pension packet is there right in the middle, pension benefit application packet. When you are preparing to retire, it is here and available for you. Let's say you need it sent out to you if your printer's not working and you're getting close to retirement. You can always request that by either calling the CSRS call center or sending an email. You'll see a temporary disability benefit packet as well if needed, and a termination refund. That means you would have separated with the state and are taking a refund of all contributions. Service purchases. So if you have time that you want to get a quote on how much it would be to buy it back, this is where you will go to do so. For example, if you want to request military time purchase, you would go here. Or let's say there was time off that you were off unpaid, this is where you would go. So you would first click on, again, everything here is underlined, so first click on request the cost of optional service purchases for which I may qualify. This will then generate, and you're going to go to Add New Estimate Request. The date will be pre-filled. You can adjust this planned retirement date and then create request. Then you will go to Add Optional Service, and a list of choices will appear. under this drop down. So you will see military time. If you took a refund, short period, you would click on and request the appropriate one. If you're requesting military service, you will see in the documentation we will also need a copy of your DD-214. That can be scanned and emailed to the CSRS email address and simply state in there, I've requested a military purchase. I want to submit this with the request, and we will forward it to our accounting department for you. That email address, by the way, is managed by the counselors here in Springfield and our manager. So we're here to help you and get that information disseminated as quickly as possible. So after you select your service purchase type, then you're going to go to the next screen and just do submit request. So there's nothing here because we didn't enter it, but whatever you have requested will show. Let's say it's military time, it will show as military, and you do submit request. That goes right into our accounting department. They will calculate the cost. When they have it posted, you'll see it appear in the inbox at the top of your screen. There will be a 1 appear, and then it will also be back at the beginning. So under the second option where it says My Service Purchase Offers with Payment Option, that's where they will also place the estimate showing you what it would be to cost to purchase it back. If you want to discuss that further, especially if it's military time and you're trying to see is it really kind of weigh the pros and cons if it's worth it, we're always happy to meet with you about that, to run the numbers with you and break it down, looking at things like what it would add to your pension and also, could it get you out earlier, those kind of things. Now, the sick and vacation contribution election is here. That's what you will click on after when you're ready to retire. Your agency will send you an email once they have your time posted. You will go on here to verify it, see the payout amount, and use it towards your pension. So you'll see that there are different ways. So any payable time you would have. So let's say you have vacation time that's going to be paid out. You would tell them how you want to pay for the 12.5%. It would tell you the amount that you're going to pay. This just has an example in there under their irrevocable payroll authorization of $1,540. It tells you exactly what it would be. Now, let's say you're already maxed out. Let's say you're already at your maximum for pension, which would be 80%. Therefore, you wouldn't need to use to pay any credit or any vacation time. You can do, I do not want to establish extra months if you're already maxed out. If you're not maxed out, we highly encourage you to do this. It's a good way to get closer to your highest number you can before you actually retire. You will then review and confirm sick and vacation election, and then you're going to verify it here, and you'll get a, once you submit it, you're going to get a verification back too. Annual statements, we just show you what's posted. They're no longer being published simply because you can run one at any time. You can also run a pension estimate at any time. It's all right at your fingertips. You no longer have to wait for a yearly statement. Now let's break down and look at retirement benefits and what to focus on and prepare for. You may hear coworkers or coffee talk or water cooler talk telling you when the best time to retire. Many people will say at the end of the year, for a couple of reasons. One is tax purposes, especially if you have a lot of payable time. So if you have a lot of payable time for a vacation, for example, and any other time you're going to get paid out, if you go, for example, 1/1 of a particular year and you're going to take that payout to yourself, typically you theoretically should be in a lower tax bracket. Therefore, your tax liability shouldn't be as high versus retiring, let's say, in October or November, where you've worked most of the year. If you have a large payment coming to you, that could throw you into a higher tax bracket. One reason is a COLA increase. Let's say a person is retiring January 1st of a year. They're already 55. They would only then wait 1 year for their increase, their 3% compounded. Let's say somebody is 55 and they go February 1st. You have to be retired a full year, and then it's the next January before that COLA would increase. Therefore, they're waiting almost 2 years. The other reason is deferred comp. Many members I talk to that have a large payout want to put as much as they can into their deferred comp. If you wait and go 1/1 of a particular year, that opens up a whole new calendar year for deferred comp, allowing you to roll most or at least all that you can into it. End of the month for retirement, that's really more verbiage for your agency to work through the end of the month to cover your insurance, because your retiree insurance will kick in the first of the month after you're done working. So you want to make sure there's no gap in insurance coverage. So you would work through the end of the month for insurance. The effective date again for retirement is always the first of the month after you are done working. I know the agency uses that resignation. You're resigning with the intent of retiring. So steps to retire. You will resign in writing to your agency. You would reach out to your agency to see what they want from you, whether it be a letter, an email, whatever that they need. You would submit a pension packet with CSRS to CSRS within 90 days of your effective date, at least 30 days ahead. Your application we've looked at is on your online account. We can always have it sent to you if you don't have a printer. You will see in the pension packet, there's a retirement checklist. CSRS will need a copy of your birth certificate, your spouse's birth certificate, and your marriage. Copies only are fine. We typically wouldn't have spouse's information at all. The only reason we would have your birth certificate at all is if you ever applied for disability. Otherwise, CSRS does not have it, even though more than likely your agency does. It does not get forwarded to us. The packet will include your checklist, and then there are only 6 pages in the packet that you actually will complete. Most of it is homework or reading material. There's a retirement application, which is 2 pages, an insurance form telling us you're going to take the insurance when you retire, direct deposit form to be completed by you and your bank, beneficiary form, which is there for you to update your beneficiaries if need be, especially if you haven't done it in a while, and the W-4P form, which is your federal tax form. And then the fact sheets are included as well, which gives you a good overview of everything pension related. The first payment check will be 8 to 10 weeks after your last day of employment. The first payment is either mailed to your home or direct deposited into your bank account. CSRS does everything we can to set it up so that you get the first payment into your bank account. The comptroller only allows so many new, quote unquote, new direct deposits every voucher. So when we set it up, we don't know if it's going to be paid out in the bank account or directly to you. When you receive your approval letter, when you see the date on there, check your bank account, or you can always reach out to us and we will look for you as well. Once that first payment pays out, then after that, it will be always the 19th of the month is when you'll get paid. The first payment will not be on the 19th of the month. It'll be as soon as the voucher can get paid out to you, and again, your approval letter will tell you that. The first payment's larger because it is retroactive to the effective date of your retirement. If you receive a widow survivor refund when you retire, it is paid out the same time as your first pension payment. It just comes as a different payment because essentially it's a different pot of money. That's why it says lump sum payment is issued with the first payment. They're talking about your pension, everything that's owed to you, and then separately if you have a survivor refund coming back, that'll be paid out as well. Unless the person, and this is for alternative formula members only, so if you work with regular formula, this does not apply to those members. Unless the member has elected to receive an estimated payment within 30 days, which is new legislation that is passed, after CSRS has received the required forms and documents. What deductions come out? So I like to point out first what no longer comes out. No more state taxes, nothing with Medicare or FICA will come out. You will pay federal taxes. Again, that's based on what you tell us to take out. If you are unsure what to claim for federal taxes, it would be in your best interest to reach out to a tax professional to ask them what you should be claiming. If you do not have 20 years for free health insurance, you will pay 5% per year that you're under 20. You will pay for dependent health insurance rates, which are the same as you're paying now. Dental insurance, you'll pay for yourself with or without dependents as well. Optional life insurance, basic is free. And if there are any other union deductions or association fees, we would need a new deduction card from them because the other deductions do not carry over from your agency. So for example, if you say, well, I already have direct deposit set up, why doesn't it carry over? Because you're in an active payroll system. This is a retirement payroll system, so it does change. So you will need to submit all of that information to set it up. Now let's again review the Tier 1 benefits and how everything is processed. Again, the person is a Tier 1 if they paid into CSRS or reciprocal system prior to 1/1 of 2011. So alternative formula non-coordinated employees who do not pay into Social Security. You know you pay in 12.5% into your pension. I mentioned earlier when we looked at those total contributions that 1% goes into a separate fund for a widow survivor. That's showing you there exactly in our presentation and our material how it's broken apart. You can see the actual dollars yourself on your own specific account under the account and then total contributions. When can a Tier 1 sworn person retire? This is alternative in general, age 50 with 25 years, age 55 with 20. There is no rule of 75. So a person can retire at age 54 as long as they have 25 years of service. There is no rule of 75. The final average compensation is the average of the highest consecutive 48 months over the last 120 months of service. For Tier 1's, alternative formula also considers the last 48 months or final rate of pay for those hired prior to January 1st of 98. If you're hired after January 1st of 98, CSRS will calculate your pension based on either your last 48 months averaged or your final rate of pay, whichever is higher. This will show you the actual breakdown, which you can see yourself as well as it applies to you, but this just shows you the formula, your number of years of service, all in alternative sworn, times 3% times either the FAC or final rate provides your monthly pension, which you can again track it as well on your own online account. The maximum for a sworn position is 80% at 26 years and 8 months. That includes your sick and vacation time as well. If you do not meet eligibility, your pension is calculated at a lower rate. You would receive a refund of 4.5%, and you must meet regular formula eligibility. So a sworn formula Tier 1 alternative formula not met. They would take your number of years of service times 2.2% times your final average compensation will give you a monthly pension. If this would be the case for you and you want to talk specific, because we don't see this a lot, we are always happy to meet with you one-on-one. COLA increase Tier 1. You are eligible for a COLA pension increase every January 1st after age 55 with 1 full year of retirement. And then it just shows you COLA just means your cost of living adjustment. That's all that is referencing. COLA buyout, a couple of reminders. At this time, you must be eligible to retire by June 1st of 2026. The COLA buyout money would have to be rolled over into a qualified IRA or deferred comp account. It will not be paid to you directly. You cannot choose any other options such as a level income, Social Security offset removal, or reversionary. You can't do both. If you have a quill draw on file, you may need to have permission from your alternate payee to accept and take the COLA buyout. Now let's look at optional service and what's available for you to purchase and add to that pension while you're working. Previously refunded service. So let's say you worked for the state previously and took a refund. You can buy time back after you've been back reemployed for 2 years. Military time for anyone who has served or is serving. Thank you for your service. You can purchase up to 48 months of active duty time. And again, if you were going to do that, you would put the request in that we looked at previously and send us a copy of your DD-214. The numbers, that is not cheap to buy the military time, unfortunately. So if you get a quote on that and you want to really discuss it in detail, reach out to us, the counselors. There are 4 of us here in Springfield. We have 1 Chicago rep. We are here to help you with these type of decisions to explain how it will impact you down the road. You can also buy a service for a leave of absence if it was after 82 and less than 1 year. And then sick and vacation days will add to the pension as well. There is also, and this is permanently in place, a permanent police transfer provision. So there are only 3 positions within the state of Illinois that are eligible for this: a state police officer, conservation police officer, or an investigator for Secretary of State. A member can transfer up to 5 years or 60 months from any of the 5 listed. Article 3 for downstate police, Article 5 Chicago police, Article 7 IMRF, SLEP only, sheriffs only, Article 9 Cook County police only, and Article 15, which is state university police time only. So if that's something that you're interested in, you would reach out to us. and then we would provide the information you need. We have an application, just a simple one-page application that you would fill out and provide to us that information listed. You would get it from your previous employer, so we would need to know the amount of employee contributions, employer contributions, and interest if that applies. That will ultimately be transferred to CERS, the period of time transferred, a monthly breakdown of your salary, number of months and years being transferred, again up to 5 years or 60 months, and has to have validation that you are a full-time officer, not a part-time officer, and you would report it to CERS. So if that's something you need, you can send an email to CERS. We do have an application in place that we can send back to you that will show you exactly and lay out exactly what we're going to need. There are different options to purchase back service purchase time. The most common one is pre-tax, and you can do that through different options here. Payroll deduction, it's irrevocable. The options on that would be between selecting 1 year would be the minimum, up to a 5-year buyback. I would highly encourage you, if you're going to do it through payroll deduction, to select a period of time that will have it paid off before you want to retire. If you do not, and you retire in the middle of paying something back, it can delay things because then accounting will have to recalculate everything. You would have to finish paying it off to us, and that can delay processing of pensions. So select a time that's going to get it done before you want to retire. You can also do a tax-deferred lump sum for any payable time. That can be used to pay time. You can do a rollover from deferred comp, an IRA, an eligible pension plan such as like TSP for military folks out there. It just has to be a qualified retirement account. Any of those can be used to pay it. When members utilize that option, it's good because you're not going to pay taxes on it, and you do not incur a penalty because it goes from one retirement fund to us, which is another retirement fund. Post-tax, you can pay it with a lump sum, writing a check, or post-tax payroll deduction. I do maybe you've only seen one of those, not common at all. Now let's look at our sick and vacation time, because this is a great way to increase your pension, make you eligible to retire, and it will also count for insurance. So first, let's look at the chart. This shows you the chart that we use for conversion. Now, CERS will either, when we receive the information from your agency, add all of your days together or separate them out between payable and non-payable time. We will do whatever gives you more service credit. Typically, I see it being split more than added together. So before we get into a little bit more detail, here's my example I like to give in person. Let's say you have 22 days total between your sick and vacation. That, when you compare that to our chart, is 1.25 months. But let's say you have 11 sick days and 11 vacation days. When we separate those out, 11 sick days you don't get paid for. That would give you 1 month of service credit for free. Vacation time you would get paid for, and it will add to your pension. It will add service credit. You would just be charged your normal 12.5% contribution rate. So therefore, instead of having 1.25 months, you'll have 2 months of service credit. Any sick time earned before 84 is free service credit. If there anyone that has some old sick payables, what we call that, you earn between 84 and 97, you get paid for half, and the other half is just free service credit. Most members have service credit or days for after 1997. That doesn't get paid. It just simply gives you free service credit in regards to your pension. So let's look at these two charts. There's 298 total sick days, top right corner. 168 of them were earned between 84 and 97, and they're paid at half. And after 97, there's 130. So see how we have it labeled. If I meet with you one-on-one, I always write pay, non-payable, or paid and unpaid. They also have 67 vacation days. So in this particular one, we would take the 67 vacation, add half the old sick payable, which would be 184. That gives that person in the payable column 151 days, which when you compare that to your chart equals 7 months. The unpaid or non-paid column would be your post-97 sick days, which is 130, plus the other half of the old sick payable, which you do not lose, you just don't get paid for it. That gives 214 days, which is 10 months. So you pay for 7 months from lump sum at contribution rate, which is 12.5%. 10 months is free. Total service credit is 17 months, as long as it's within 90 days of retirement retiring for the payable column. Payable column, if you're going to get paid out for time, you have to be eligible to retire within 3 months to use it towards your pension. Let's simplify it a little bit. This is where this is going to apply for most people. Let's say they have 67 vacation time and then 130 unpaid sick days. You see how it's broken apart. So think of the paid column as a double dip, but a good double dip. I always say that when I'm in person. You'll get paid for those days by your agency, which is who you earned them with, the month after you're done working, and it would add 3.25 months of service credit by you paying 12.5% into your pension. Sick days would be 130. That's 6 months. You won't get paid for it, but it adds 6 months of service credit. Total service credit here is 9.25 months. Now for state troopers, you also receive your annual 60 or push time. That would get added right to whatever your sick days are there. So we would account for that as well, just a side note on that, which we would do one-on-one with you to explain it too. But just know if you have the 60 sworn or 60 annual, you would add it right to whatever sick days you have in the unpaid column. So this is just showing you the non-coordinated vacation lump sum check from agency. They'll withdraw or withhold 12.5% for sworn officers. That gives you service credit if you need it to get to either eligibility to retire or trying to get closer to that max. Now let's look at some reciprocal systems and how they can help you. There are 13 Illinois pension systems or reciprocal systems within the state. You make the choice at the time of retirement to use reciprocity. If you took money out, you would have to repay the contributions to that system that you took a refund from. You have to be employed with CSRS typically for 2 years before it's allowed to buy it back. The minimum requirement for reciprocal time is 1 year or 12 months. So let's say you're going to have 75% with CSRS because you're going to have 25 years, but you did a year of teaching. Then if you have a year of teaching, you could retire. You would get a check from teachers based on what your final average compensation is. Typically it would be us higher. And then what you also earned with us. Just as a little side note example, we can break that down, but it's not going to add to your alternative time, the other system. It tells you that here. The reciprocal time does not add to the alternative eligibility. The only way it would add to eligibility for alternative is if you fell under the permanent police transfer provision, meaning you're transferring one of those 5 systems to us to be incorporated into the CSRS system. Not all reciprocal systems time counts towards insurance. There's only a couple that do, which would be teachers and state university time if you had insurance while working for them. Here's the list of the reciprocal systems within the state of Illinois. If you've worked at any of these and would like further information, maybe you're not sure how long did I work there. I know for myself when I was in school I worked for the university. It took me forever to realize that might be reciprocal. It wasn't because of how I was paid, but it's worth checking into. On our website under publications, you'll see fact sheets. We have a listing of all these systems with their contact information as well there for you. It's on our website under publications. Now let's discuss reversionary option. This is an option a member can elect at the time of retirement that reduces your pension to provide a lifetime income to your designated dependent, which could be a spouse, a dependent at the time of retirement. You can choose between 10 and 100% in 10% increments and additional money to go to your dependent. There's no COLA increase on that reversionary amount if you choose it. So let's break it down a little bit more because we already have known and established that our survivor, if you pass away first, myself as well, for Tier 1 members, our spouse gets half of our pension if we pass away. So let's look at an example what they're trying to show you here, different options to run. This person wants to do 100% of their pension to a dependent, to the survivor. Their pension is $4,000. We have a chart that we would utilize, and we would need to know obviously your birth date, your age, and what your spouse's birth date and age would be at the time of retirement is how we calculate that. So keep in mind that's already done ahead of time when you look at this estimate or example. So in order to provide 100% additional pension to your survivor, CSRS would take $433 a month from the pension. Now that member's pension is $3,567 per month. So let's say now the member dies. $3,567 per month for the survivor to receive the reversionary in addition to their regular survivor benefit. So in this example, their 100% pension, their surviving spouse would get $3,567 plus another half because that's the automatic benefit that's built in, 50%. In this example, the surviving spouse would be receiving more per month than the member did while they were retired. The survivor benefit always gets the increases, the 3% compounds. The reversionary does not get any increases. It would stay flat. Let's do another example of 50%. Same amount as far as the pension. The pension is $4,000 a month. The member selects and says, I want an additional in reversionary to go to my spouse, 50%. So CSRS runs the calculation. It would cost the member $230 per month to guarantee their spouse 50% of their pension additional as reversionary. So now if the member passes, $3,770 for the survivor will be paid. They get $1,885 per month as a reversionary and $1,885 automatically as a survivor benefit for a total of $3,770. The survivor benefit portion gets the 3% compounds on it annually after a year. Reversionary would not and does not. If this is something you are looking at doing, again, we're happy to meet with you one-on-one to do that. We do this all the time to kind of show you what your numbers look like. And again, it doesn't have to be a 50 or 100. It can be between 10 and 100. Let's say your spouse has stayed home a number of years and you're concerned if you were to pass away, how would they be making it, what their income would be. If this is an option you want to look at, we're here to walk you through those different options. So elections, as they apply to you at the time of retirement, if they apply, Social Security offset, level income if you contribute to Social Security, those two typically do not apply to sworn officers, reversionary, or any combination from above. A COLA increase when you're eligible for that. Let's cover disability information here. So disability, there are three options. There is not short or long-term disability. There is non-occupational, not work-related, occupational, meaning work-related, and temporary. So we'll break it down. The one thing I always want to point out when we're into the disability section, if this were to happen and you were become unable to work and you want to go through options, reach out to CSRS, and we're here to walk you through that as well. If you are injured on the job, you have to be a member of CSRS. You would file a claim with work comp and receive benefits or a settlement. You would still file the forms with CSRS. You do not have to use any benefit time to receive that occupational disability benefit. So, occupational disability is paid at 75% of the member's final average compensation or their monthly rate of pay on the date removed, whichever is greater. This is a Tier 1 formula only. So this is specifically for Tier 1s, 75% of either, whichever one is higher. The benefit amount is reduced by any payments made under the Workers' Comp or the Workers' Occupational Diseases Act. So typically work comp will pay 66 2/3. CSRS picks up the other 8 1/3, but CSRS then also pays into your pension. So you wouldn't be missing any months. So it's crucial to know that just know that this option is there if this were to ever become part of what you had to do. Because even if you're getting work comp, if you never apply for CSRS disability occupational, they won't pay into your pension and you're still eligible for another 8 1/3% payout. You do not have to use sick time. The FAC for Tier 1 members is the average of the 48 highest consecutive months of service within the last 10 years. The disability would end when your disability ends and your doctor releases you to go back to work at the state or somewhere else. The work comp ends. You reach age 65. If your disability were to begin after age 60, benefits are payable for up to 5 years. Temporary disability is an option if you've been denied work comp or it's been suspended. So an approved medical leave of absence is not required. Members do not have to exhaust their sick time for temporary. If it's denied, CSRS would still have to determine you are disabled. You have to have at least 18 months of service with SERS or Teachers or State University. The claim that it was denied. You would have to file an appeal with Illinois Workers' Compensation Commission. You submit those required forms to SERS. And then you would have to be off the payroll for 30 days. You have not received or had a right to receive any compensation for at least 30 days. If TTD is determined, SERS determines you are disabled. You have at least 18 months of service credit. You submit the required forms to SERS. You file an appeal. You have served a 30-day waiting period from the date you were last paid. When a work comp is denied, if the work comp denies a claim and the member is not going to appeal the decision, they can apply for a non-occupational disability benefit. If you're going to do that, you would submit a letter to SERS stating you are not appealing your denial and that you would not now or any future seek compensation from the Illinois Workers' Compensation Commission for your injury or illness. Which rolls us into the non-occupational disability. So if it's non-work related, you have to be eligible. You'd have to have 18 months of service with SERS, with us, Teachers or State University. They do make you use all of your accumulated sick leave. You would have to be granted a medical leave of absence from your agency. You must apply by submitting all required forms to SERS, which is the packet that's on your online account. All of these are on your online account. SERS would have to determine you are disabled. Disability must be expected to go beyond 30 days after stopping work. A person can stay on non-occupational disability half the time they worked for the state or until they reach age 65. If disability begins after age 60, benefits are payable for up to 5 years. So an example, if you work 10 years, you can be on disability for 5 years as long as obviously the doctor deems you're not able to work. For Tier 1 members only, this is a Tier 1 member only slide. Non-occupational terminated after halftime. So if the non-occupational benefit is terminated because of the halftime ceasing, but the member is still disabled and unable to work, they are eligible for an unreduced pension if the member is 60 with 8 years of service credit, 55 with 15 years, 50 with 20. If they go early, they cannot receive a COLA increase until they're age 60. Tier 1 non-occupational, how much can they receive? 50% of the salary or the final average compensation on the date removed from payroll, whichever of those is greater. Pregnancy and non-occupational disability. Since members now receive 12 weeks of maternity leave, most will no longer qualify for the SERS non-occupational disability benefit. If the member has a medical condition that would keep them off of her maternity leave, she will have to supply medical evidence to support the inability to return to work. It does not apply to tollway. Members who are taken off of work for a medical condition prior to delivery can apply for SERS non-occupational disability. Medical evidence of the member's need to be off work must be submitted, and the member must be off work more than 30 days prior to the expected date of delivery to qualify. Non-occupational disability benefits would be reduced by, if a person is approved for Social Security, then SERS would reduce the payment, and the amount of pension a member is eligible to receive from Social Security if the member has reached full retirement age. SERS benefits are reduced even if the member is not drawing their full Social Security retirement benefit. Any SERS benefits received during the same time as a retroactive Social Security payment would result in an overpayment. While receiving a disability benefit from SERS or with SERS, whichever one, if you're approved for whichever one, your service credit continues to be applied to your account as if you were working. So this is really important to know that you won't be missing months. That way you will not be missing service credit when you're ready to retire. Please keep in mind though, if you did not have enough benefit time to cover your 30-day waiting period for non-occupational disability, you may want to purchase that time after returning to work. So if anything, the most would be a month to have to purchase back. It depends on how your pay dates would fall, which we could look at specifically with you if and when this applies to you. Let's say you're on disability and your agency wants you to resign. So it's very important to note that you have to be on the disability benefit before you would ever think about resigning. Members may resign from their agency and remain on SERS disability benefits as long as they are still disabled and continue to meet the SERS eligibility requirements. but you have to be established on the CSRS disability benefit before you would resign from your agency. It's a very crucial point to know. The resignation allows the agency to post and fill your position if it comes down to that. Now we're going to focus on death benefits. Not the most pleasant subject, but we're here to explain what that benefits are in the case that it arrived and that was needed to be utilized. So let's first look at survivor benefits and who are eligible survivors: a spouse or civil union partner, minor children under age 18, full-time children, students unmarried under the age of 22, disabled children of any age, dependent parent. It's rare, but it is written into the pension code that is also considered a survivor if it applies. Death benefits while you're working, an active member with qualified survivors. Survivor benefit would be a $1,000 lump sum, monthly annuity, 50% of the earned pension, insurance, and the retirement contributions portion to the nominated beneficiary plus interest. We looked at that early on under your benefit tab for a one-time payment while you're working. Death benefits active members, no qualified survivors. All contributions plus interest to the nominated beneficiaries or estate, and 1 month's salary for every full year of service. Up to 6 years is the max. So they could get another 6-month maximum, 1 month minimum additional payout for a month's salary. Once you're retired, the survivor benefit payout is a $1,000 lump sum, a monthly annuity if married for 1 year at the time of death, and the survivor contributions are applicable, meaning you never took them or you bought them back. Insurance, possibly if the member was on the insurance upon when they passed away, the survivor would be eligible for whatever the member earned, meaning if you've earned free health insurance and you have it and you pass away, that benefit would transfer to your spouse. Or if there's no survivor, there would either be a refund of contributions if there's any money left, or $500, whichever is greater, to whoever you list as beneficiary. Effective July 1st of 2009, the survivor offset only affects members who contribute to Social Security. Therefore, your survivor benefits would not be impacted. So let's look at some CSRS insurance information. This is based on current policy today and is subject to change. How can it be changed? Well, through legislation, contract negotiations, or policy and rule changes. Read all of your information in your pension packet. There's an informational sheet in there. And the retiree insurance form that you're going to complete is Form 3991. It is in your packet already. You don't have to go searching for any of the forms that you will need to retire. They're all included in your pension packet. In order to qualify for state insurance, you have to be vested with SCRS and collecting a monthly annuity from CSRS. Tier 1 vesting is 8 years of CSRS credit. My Benefits is the service center will assist state members with insurance. So when you retire and you turn in your pension packet, CSRS will notify My Benefits about 2 weeks before your effective date of your retirement. Then My Benefits will change you from an active member to a retiree, and typically the 3rd week then of that month. So let's say if someone is going to retire July 1st of a year, CSRS notifies My Benefits in the middle of June. The 3rd week of June, you would be advised to reach out to My Benefits, either by calling or via their website, to ensure everything is moving over for your retirement date as you want it to. It's also a time where you can make a change, but just to have that verification. I tell people this all the time. No one has ever called me back and says it's not done, but just so that you have your own peace of mind. Changes to insurance can be made during retirement, qualifying life event, or benefit choice period. So let's say you're going to be moving out of state when you retire. You would be encouraged to reach out to My Benefits ahead of time to see what options are going to be available in the state that you're looking at moving to. Retirement dates coincide with insurance eligibility. Retirement date, again, is always the first day of the month after you are done working. Retiree insurance becomes effective the first day of your retirement. So here, best if on agency payroll, it says 1 to 2 days into the second period for insurance of the last month that you're working. You really, in this particular instance, you really want to reach out to your payroll system to make sure, let's say you want to be done working on, you're going to go January 1st of a year and you want to be done working December 20th. You want to reach out to your agency to make sure that that's going to be enough to cover your insurance, or are they going to require you to work through the end of the month? That's more of a CMS decision and individually has been then put upon the agency. So reach out to your agency if that's what you're looking at doing. Premiums for the state insurance will automatically be deducted. CERS we cannot see what you have for insurance or life insurance. My benefits typically they just notify us what to remove from your monthly pension. In the event your check is not sufficient to deduct the premium, CMS will bill you. Not common. Once in a blue moon I'll see it, but not common. There is an opt-out financial incentive for retirees only. In order to receive an opt-out incentive, you must be enrolled in state insurance at the time of retirement to qualify for that incentive. So for anyone who's not enrolled when you retire, you will not be offered this. You have to be enrolled in the state insurance in order to be eligible for the opt-out financial incentive when you retire. You would have to provide proof of another health insurance plan. You have to be non-Medicare, meaning under 65. You would pay tax withholding. CMS pays for the actual incentive. You would receive $150 per month if you have less than 20 years, $500 per month for 20 years or more. You're still eligible for life insurance, but not eligible for health, dental, vision, or prescription. This benefit is only there until you turn 65, and then at that time it would expire. You can opt in then during benefit choice, or if you were to lose other health coverage. So let's say you're going to get free health insurance at a new company you're going to go to work for when you retire, and you decide to opt out of the state insurance, but then down the road that job ends, you could opt back in at that time. Reciprocal time for insurance. You have to be vested with CERS before reciprocal time would count, meaning 8 years or more. Reciprocal systems that can count for insurance purposes, teacher retirement is all the time. I mentioned it kind of briefly earlier, state university, if the member carried state insurance while contributing to CERS, meaning state university. SERS would contact them to verify if the time can be used with CERS time. General Assembly all the time, judges is all the time. We singled out IMRF here because IMRF is a very common reciprocal system to retire from, but it does not count towards your insurance, only your pension. Members' health insurance premiums will be based upon 20 years or more of service is free. If you have less than 20 years of service for your insurance for yourself, you would contribute 5% per year that you're under 20 years. So if you have 18 years of service, you would pay 10% of the premium for your insurance. The dates and rates, I should say, are always updating. We always have them posted on our website under insurance at our website. Under insurance, we always have the most current benefit choice booklet out there for you to review to see what you are paying for your dependents as well. My Benefits obviously has it posted as well. So we list both of those websites as a resource for you. Dependents can continue, add, or terminate dependents at retirement. Rates are the same for dependents of retirees and employees. Again, located in that current benefit choice booklet. We post what they send you every year. We always have the most current one posted on our website, or it's online at the My Benefits website. If a dependent is Medicare Prime, health insurance rate will reduce if the member is retired. There is an annuitant waiver, Public Act 97-0668. It states, in order to be eligible to make such an election, the person must have been enrolled as a dependent under the program of health benefits for no less than 1 year prior to becoming an annuitant. So what this means is, let's say someone is separating from the state, and let's say the person doesn't have 20 years for insurance. They're separated from the state, they go on their spouse's insurance. For example, their spouse is a state employee or retiree. After they've been on there a year, once the person goes to retire, they will then at that point have a choice whether to remain as a dependent on the spouses or go on their own. Again, this is not something super common. If that applies to you and you want to discuss further, or a spouse, we're here to help you with that, but that just gives you the details of it. So a survivor insurance, some basic information. Survivor eligibility. The deceased member must have been vested in CSRS 8 years. The survivor must be eligible to receive a monthly annuity, which would be married at least 1 year prior to death, and age 50 or over unless there's a dependent child or children under 22 still full-time students. Then the spouse could still qualify even if they weren't 50 as your survivor. Medicare is a federal health insurance program for individuals 65 and older, individuals under age 65 with certain disabilities, and individuals at any age with end-stage renal disease. We do have a Medicare fact sheet for more information when this applies to you. It's on our website. It's also included in the packet as well. CMS does mail a letter to the member 90 days prior to turning 65 to remind them to apply for Medicare A and B. It provides important information on both the requirements to enroll in Medicare and the transition to TRAIL, Medicare Advantage Prescription Drug Program. If you and or your dependents receive or have Medicare cards from Social Security, please send a copy of the cards to the CMS Medicare Unit, Coordination of Benefits, to ensure your insurance is coded correctly to avoid any claim or premium errors. This is their information. So they basically act as a liaison between the state insurance and Medicare when you are turning 65. Their contact information is also available on the Medicare fact sheet. We just put it in here for you as a quick reference to review. Life insurance when you retire is still administered by MetLife. That is their contact information. Again, CSRS cannot see what you have while working or when you are retired. The benefits available when you are working at any age and retired under 60, you get your basic for free, which is 1 year of your annual salary, up to 4 to 8 times. Combined AD&D, $10,000 for a qualifying child, $10,000 for a spouse if the spouse is 59 or younger. Once, and it's the same for all of us regardless of formula or job title, once we are 60 and over and retired, we will receive $5,000 in life insurance for free. At that time, you can purchase 4 times that amount. Combined AD&D, there's a $10,000 child life for a qualifying child, and the spouse then would be eligible for $5,000 in insurance. There's another option called NCPERS, which is Voluntary Group Life Insurance Plan, National Conference on Public Employees Retirement System. It's for active employees only. Retirees are not eligible to apply. So typically they have this offered. Normally I've seen it for many years in the fall. It's an additional life insurance. It's decreasing term life that provides money for you if you were to pass away, a spouse, and a qualifying child. The reason we pointed out in our presentation to you is that if you have this while working, when you get ready to retire, if you want to continue it, you can. This is in addition to your MetLife, so it's an additional life insurance coverage. It's $16 per month, and it would not go up when you retire, and it's payroll deducted. The enrollment for active employees, it's to be announced. Typically, it's done in the fall. There is, under our insurance link on our website, there is a link to the NCPERS information, which takes you, it's Prudential Life, and it shows you who the administrator is to member benefits. Other important resources, we have a list here for you to review. Obviously, we have the State Employees Retirement System information listed, CMS Deferred Comp, Social Security Administration, My Benefits for any insurance, and Empower is the point of contact for any deferred comp questions or clarifications. I do want to mention here for the deferred comp, when you submit your pension packet, CSRS does notify deferred comp that you're retiring. We cannot see if you have an account, let alone any balances in there. But we do notify them. So then you would work with them on however you're going to utilize that money, because that's something you did separate. We're here to help you with the piece of information, which is your pension, and then you would work with Empower on however you want to manage that information, that money, whether you take it, leave it, start taking a draw. I hope this information has been helpful to you, If you have additional questions, you can always call our call center, send us an email. If you want to schedule a time to speak with a representative, a counselor, we can see you. You can schedule up to 3 in a year. So we're happy to help you as you get ready to plan for your pension. I hope this has been helpful and have a great day. Thank you.